They warned me. Dividend investing is dangerous, they said. It's outdated. It drags down your portfolio. It's only for aunties, uncles, and retirees. But here I am, cash flow rich. And I didn't get here by chasing meme stocks or praying to the crypto gods. I got here by collecting dividends, quarter after quarter, year after year. Sometimes from simple, stable counters like Keppel Infrastructure Trust. Not glamorous, but it pays. So, was it really that dangerous? If you believe more Singaporeans should hear the other side of the story, give this video a like, subscribe to Wealth for You, and stay till the end. This might change how you think about growing your wealth. Just a quick disclaimer. This video is for education and sharing only. It's not financial advice. Please do your own research before making any investment decisions. I'm just sharing what worked for me. And maybe it'll work for you too. Chapter 1. What is dividend income investing? So before we go further, let's clear something up. What exactly is dividend investing? It's simple. When you buy shares of a company, especially mature, profitable ones, they may reward you with a portion of their profits. That payout is called a dividend. These dividends can be paid quarterly, semi-annually, or annually. They can be deposited directly into your bank or CPF investment account. If you bought with CPF OA, you can reinvest them to buy more shares, or just use them to pay your bills. In Singapore, common dividend-paying investments include blue-chip stocks like the local banks, DBS, OCBC, UOB, as well as REITs, which are real estate investment trusts, and business trusts like Keppel Infrastructure Trust. When you invest for dividend income, you're not trying to flip stocks for quick capital gains. You're playing the long game, building up a reliable stream of passive income. Think of it like this. Capital gains are hope-based. I hope the price goes up. Dividends are cash-based. I get paid while I wait. And that's why it's powerful. You can eventually reach a point where your dividend income covers your daily expenses, unexpected bills, or even gives you the freedom to work because you want to, not because you have to. But wait, didn't they say it's dangerous? Chapter 2. Why do some people say it's dangerous? Now here's the thing. Every time I mention dividend investing, confirm plus chop, someone will say, "Bro, dividends are a trap. It's inefficient. You can get better returns just buying growth stocks. Dividends are for aunties, not serious investors." Let's break this down. First, it slows down your returns. Yes, it's true that high-growth stocks can outpace dividend stocks, in theory. But here's the catch. It only works if you buy at the right time and sell at the right time. That's not investing. That's timing the market. With dividend investing, I don't need to guess. I collect income, rain or shine. Next, dividends are not guaranteed. Also true. Companies can cut dividends when times are bad. But if you do your homework, pick businesses with resilient cash flow, healthy balance sheets, and track records of stable payouts, you're stacking the odds in your favor. Some Singapore REITs and trusts, for example, have paid dividends consistently for over a decade. And finally, it's better to focus on capital gains. Why not both? Dividends are returns, and if you reinvest them, guess what? You're compounding. So while others wait 10 years to sell and hope for a payout, I get paid every few months. So no, dividend investing is not outdated. It's just misunderstood. The truth is, when done right, dividend income can be your financial safety net. Let's go deeper into that next. Chapter 3. How dividend income acts like insurance. Here's the part most people never talk about. Dividend income isn't just about returns. It's about resilience. It's like having insurance for your lifestyle, except this policy pays you. Imagine this. Next month, your job vanishes overnight. Your child suddenly needs urgent tuition. Your elderly parent's hospital bill doubles out of nowhere. What do? Most people panic. They drain their savings. They swipe their credit cards. Some even cash out their investments at a loss. But if you've built a dividend-paying portfolio, even a modest one, you're not helpless. You have a lifeline. Here's a simple way to picture it. Your expenses are a tap. Your dividends are a pipe. The stronger the flow, the less you need to touch your water tank. Your savings. And that flow? It keeps your emergency fund intact. It buys you time when things go south. It gives you dignity when others are drowning. Because here's the truth. The real risk isn't the market crashing. The real risk is your income crashing, while your bills keep flowing. That's why dividend investing isn't just for retirees or aunties. It's for anyone who wants peace of mind. Even in chaos. It's not just wealth. It's stability. That's why this matters. Chapter 4. Why I choose to be cash flow rich, not just net worth rich. Let's clear something up. Being rich isn't just about how much you have. It's about how much you can use. You could be a millionaire on paper, but if your money is stuck in property you can't sell, or in stocks that don't pay a single cent until you sell them, then guess what? You're not financially free. You're asset rich but cash poor. And if a crisis hits, you can't tell your condo to pay for dinner. You can't sell your car every month to cover groceries. That's why I stopped chasing net worth and started building cash flow instead. With dividend income, my money flows back to me, again and again. I don't have to rent out a room. I don't have to time the market. I don't have to sell shares just to pay bills. Instead, I collect income. Even when I'm not working, it's not a flex, it's a strategy. Because being cash flow rich means I can survive downturns. I can sleep well at night. I can say no to jobs that don't serve me. And here's the beautiful part. You don't need to be a high flyer to make this work. You just need consistency and time. Start small. Stay steady. And one day, your money works harder than you ever did. Because in the end, freedom doesn't come from what you own. It comes from what pays you, month after month. Chapter 5. What kind of dividend stocks build cash flow for life? Featuring Keppel and Global Marine Group. By now you're probably thinking, okay la, dividend investing sounds good, but what stocks are we talking about? Let me break it down with a real example someone on this channel asked about Keppel Infrastructure Trust, or KIT. When it comes to dividend investing in Singapore, here's what we want. 1. Steady, predictable cash flow, no wild swings, no drama. 2. Consistent payouts to shareholders. 3. Strong fundamentals that hold up, even when markets go crazy. Sounds simple? It is. But not every company ticks those boxes. That's where trusts like Keppel Infrastructure Trust or KIT comes in to show how dividend investing works in practice. KIT isn't flashy. It doesn't make headlines like the next hot tech IPO. KIT owns essential infrastructure like power plants, water treatment, waste management, and undersea cable systems. Boring? Maybe. But boring pays. Key financial highlights. 1Q 2025. Distributable income, 65 million Singapore dollars, increase by 28%, year on year, though $19.5 million was one-off. Steady-state distributable income is 45.5 million Singapore dollars. Dividend yield, 7%, around $700 a year for every $10,000 invested. Assets under management, 8.3 billion Singapore dollars, one of Asia's largest infra trusts. Recent acquisition, Global Marine Group or GMG, boosts DPU by around 3.5%, adds stable digital infra income. Financial strength, net gearing, 40.8%, which is below the 50% threshold. Interest coverage, 6.8 times, very healthy. 75% of debt fixed or hedged, well managed in high-rate environment. Why it matters. KIT shows how consistent, regulated cash flows can generate sustainable dividend income. It's not about hype. It's about income you can count on. But do remember, don't just chase yield. Make sure it's real, sustainable income, not funny business. So yes, we still have to watch things like whether the dividend is backed by actual earnings, whether the company is over-leveraged, whether they're borrowing just to maintain payouts. But overall, Kit gives us a powerful reminder. Dividend investing isn't about hype. It's about cash flow. You're not trying to strike gold. You're building a stream, one that supports your life, bills, and freedom. So don't ask, will this stock make me rich overnight? Ask, will this stock help me become cash flow rich for life? Chapter 6. The Dividend Mindset. What it really takes to win long-term. Let's wrap this up with something even more important than stock picks. Because here's the truth. Dividend investing is less about timing the market and more about how you think. You don't need to be a Wall Street genius. You don't need to trade every day. You just need to build the right habits and let time do the heavy lifting. That means being disciplined, investing regularly, even when markets feel uncertain. Being patient, letting your dividends compound month after month, year after year. And being intentional, focusing on cash flow, not just paper wealth. Too many people are chasing net worth numbers. But here's the thing. Net worth can't pay your grocery bill. Only cash flow can. That's why I say, don't just be rich, be cash flow rich. So if you're starting out or restarting your journey, remember this. Start with what you can afford, reinvest your dividends, avoid hype, buy businesses, not stories, and protect your downside like an insurance plan. Because the goal isn't just to grow wealth, it's to live well. Chapter 7. Quiet Dividends, Loud Freedom. Let's be honest. Dividend investing doesn't look cool. You're not flexing crypto charts or chasing the next Tesla. You're not beating the market. But here's the truth most people don't want to hear. You don't need to beat the market. You just need to build cash flow. Because being cash flow rich means you don't panic when your boss suddenly calls you into a meeting. You don't stress over stock market dips. You don't lose sleep when the economy slows down. In fact, you walk differently. You carry peace in your back pocket because you know dividends are on their way. You don't need the next big thing. You just need to own things that pay you, quarter after quarter, year after year. So what should you do next? If you're in your 20s, 30s, or even 50s, it's not too late. Start small. Start simple. 1. Buy your first dividend-paying stock, REIT or ETF. 2. Reinvest the payouts. Let them snowball. 3. Don't touch the hype. Touch the income. 4. Be boring. Be consistent. Be free. Wealth doesn't always look exciting. Sometimes it looks like collecting $200, $400, $1,000 a month while doing absolutely nothing. That's how I got here. Final thoughts. Yes, they warned me. They said dividend investing was old-fashioned. They laughed when I told them I liked boring, stable income-generating stocks. But today, I'm cash flow rich. I sleep well. And when bills arrive, I don't stress. I smile. Because my dividends already paid for them. If an everyday Singaporean can do it, so can you. If you found this video helpful, give it a like so more Singaporeans can watch it, share it with someone who needs peace of mind, and subscribe to Wealth for You for more practical money wisdom. And don't forget to tap the notification bell so you never miss a new video. Remember, it's not just about being rich on paper. It's about being cash flow rich where it counts.